Good afternoon, everybody. This is Steven again with the Padernacht real estate team at Keller Williams in the Bronx. And we are back with another episode of Mortgage Matters. This is episode number 11. And we are joined today by Christian Babcock, once again, my esteemed co-host from the Loan Depot. The market is taking twists and turns, and it's important to stay in the know. And that's what we try to do for you here today. So without further ado, I will introduce Mr. Babcock.
Yes, sir.
The esteemed, the one and only.
I'm telling you. So,
How we doing?
Getting more respect each episode. We must be doing something right here.
Yes, sir. Yes, sir.
Doing good. How are you?
I'm doing great. We talked a couple minutes ago, and the word of the day is closing.
Yes, that's right. That's always the word of the day. Always be closing, my friend.
Always be the ABCs of sales, right?
That's it.
Let me ask you a question. Before you were doing loans, what kind of jobs did you have?
Good question. Yeah, I grew up. My father had they developed like an commercial HVAC company, but they did mostly commercial controls. So all through high school and college, I was in and out working for him, mostly in churches and schools in the Archdiocese in the city and Bronx, Westchester. But then out of college, I actually went to college to be a teacher, an English teacher.
Really?
I actually went back to Fordham to do some like student teaching there when I was in school. Ended up not teaching, but then got into, I worked at a company that sold computer training to like companies' end users. So they would find decision makers for companies, bring them in for a class. And I got into that actually teaching the classes. So I was teaching things like Microsoft Word and Excel and front page. And, at that time too, I was really much into doing, computers. So that my teaching background in that was a great fit. But then I got into the sales part of it. And when I really excelled there, I started with selling. Then I was a sales manager, and I managed like 20-person sales floor, was charging all the hiring, firing, training. And the training was great because it was a much different sell than selling mortgages, because in that business, we had to bring people in and convince them why they needed what we were selling first. It was called creating the need. Because decision makers were coming like, why do I need to train my people how to use Microsoft Office? Why do I need this? So we would show them how good the classes were, and then create that need and say, look, you think you'd be more productive if your people were more proficient in Microsoft Office and all these other programs, and then sell it. So when I got into mortgages, with that background, it was much easier because people were coming in with a need already. When I worked at Bank of New York, I covered all the branches for Bank of New York in the city of Yonkers. And growing up in Yonkers, I knew the whole neighborhood. I got to meet agents and kind of springboard from the branch relationships into building out a network of realtors and everything else from there. But every customer that came to me needed a mortgage, so I didn't have to create a need. Mm-hmm. I just had to basically have a great product and be good at what I was doing for them to work with me to satisfy that need. And that's still true today. I mean, it's our people come to you, they need a place to live. It's our, and they need, and if they're going to buy it, they need a mortgage, or unless they're all cash. So they have the need already. Everybody needs a place to live. Everybody needs a roof over their head. So it's like selling shoes. Like people going to a shoe store, you need a pair of shoes, you're going to walk out with a pair of shoes. But having that background, it was we went to tons of training courses, how to handle objections, how to, and it was a cutthroat business. It was all telemarketing sales. Like people were just banging out phone calls, trying to find the right people, bringing them in, and, we monitored every call times, average call times, how many calls they were making per day. And I'd be hiring 6 people every month and firing 3. It was a very interesting experience, and gave me a lot of background on how to sell.
So it's hilarious. And as we continue, now we're on episode 11, the similarities just continue to show themselves. Because when I was in college, I worked for a company called Cutco, the knife company. And it just a lot of sales, and that was more of like a multi-level sort of marketing company. But that was the first like sales job that I had. I didn't do it for very long just because I felt weird, like going door to door. This is before like the internet. It wasn't really before the internet, but very early on. We're talking like late 90s, early 2000s. So like it was dial up. So like you literally like knocking on people's doors. And then I left that and I did I worked for a company called Sentry Home Detection. And I was one of the guys in the call center. You came in, you threw the dialer, the headset on, and a script came up. Mr. and Mrs. Jones, this is what you're telling them. And then if you got somebody who was interested, you just you put your hand up, and then and the closer comes over.
Oh, fine.
Yeah. So those two experiences gave me such a background in sales, and I think a lot of us, that are in this business have some sort of starting point, and and you take it with you, and you find what drives you. And what drove me was every time I raised my hand, I knew I had an opportunity to make an extra bonus. Right. So I was, I excelled in it. I did very well. I mean, I was in college, so like I only did it a couple hours a week, but still, it just kind of led me into this world of sales.
Yeah, if you ever really want to like dig through a real like sales experience, sit through a timeshare sales. You ever done one of those?
I have, and I've been the one.
You were the guy that bought one?
Bro, I kid you not. Next time you see Jen, ask her about our timeshare. The first year we started dating, I was like, babe, look, they got this this trip over here. All we got to do is go sit through this little presentation, and then we could win a free whatever. And she was like, all right. We went there, and I walked out of there, and I bought a timeshare, and I've never even used it.
Yeah. It's tough.
I'm paying for it $100 a month. I'm paying for this stupid timeshare. I've never even used it.
My coach was she was a beast with timeshare. She loves the business of selling timeshares, and she was my sales coach. And so, but I had sat through one. My wife and I were in San Francisco, and it was just like a really rainy day. We're hanging out by the wharf, and they were offering like a free bus tour if you sat through this thing. So I'm like, all right, let's check it out. It was a free bus tour, like through San Francisco. So we sat through the thing, and I'm like, wow, because I had the sales background. I'm like, it was so structured. Like you got your first guy comes in, it's like, going over everything. Then he tries to sell you. You're like, no, I'm not interested. Then they get the next person. Then they get the closer in the end who's like trying to really make the deal. It's very interestingly structured, and how they make it flow they make it really look like it's just kind of naturally happening that way, but it's so structured. And it was really difficult to say no at the end. I was like struggling, but those types of things though, you really have to, in timeshares especially, like you really have to be dedicated to traveling to do a timeshare.
That's the first time that I actually experienced the pen close. When they put the pen down, and I'm like, nah, I'm good. I'm gonna wait. And say, oh, okay, cool. So they pull it back, and then somebody else comes over, and they're like, listen,
$500 off.
Today. What they did to me was they told me that they were like, look, so that room over there is filled with people, and we only have limited spots. So I'm like, oh my god, like come on, man. I was like, oh, me up, and Jen was just looking at me like, I can't. I'm like, nah, babe. We just started dating, so I'm like, no, babe, I'm gonna take you to Hawaii. I'm gonna take you.
I mean, they do say the easiest people to sell are other salespeople. They say that.
All right, so let's pivot a little bit. I think you said that this week was an inflation report coming out.
Couple back-to-back inflation reports, CPI and PPI, last week and this week. Both came out hotter than expected, slightly hotter than expected. Well, I mean, depending. Core CPI and CPI came out a little bit different. One was a little cooler than expected. One was, when they look at month-to-month versus year-to-year inflation, one came out cooler, one came out hotter. But, the broad headline is that inflation is still sticking around. The Fed is still not really saying anything except they're going to continue to watch the data and decide when they're going to pivot. Politics are obviously involved, even though the Fed says that they are not influenced by politics. I just read an article the other day that both sides Republicans and Democrats are pressuring Powell like big time to make one side doesn't want him to do anything, the other side does, and he's really trying to stay insulated from politics, which is probably impossible. So yeah, it's going to be a very, very, very interesting year, both politically and economically, and how those two things are really very closely tied together.
Yeah. Well, they always say election years is when there's a lot of volatility because you got the side that's especially when you have an incumbent. Let me ask you a question: Who appoints how do you get appointed to be the commissioner of the Fed? Who appoints that position?
The president makes that appointment. Yeah.
So how is it that you're telling me that you're not influenced by the guy who?
Well, I think Powell was actually carried over from the Trump administration, so he wasn't a new appointee by Biden, as far as I know. But yeah, I mean, it's an interesting dynamic. I wouldn't want to be in that guy's seat, but Powell's been very steadfast in not showing his hand really at all and not really saying anything. He said he's really stayed on message, that for the last year and a half. It's a matter of, when they start dissecting the press conference, and it's amazing. I've watched those press conferences as they've happened, and you'll see mortgage-backed securities trading one way, and then literally he'll answer a question, with just a little bit of either, hawkish or dovish information, and you'll see it go like drop off a cliff or go or skyrocket back the other way on one sentence. Wow. It's very, it's crazy. It's crazy.
So these two reports, I think you said it was two reports. How does that affect? It really hasn't affected rates at all. Rates are pretty much.
They've gone up in the last couple of days. They have gone up. But again, it's funny because when you catch headlines, like a lot of people's like, "Oh, I heard rates went down." I was like, "Yeah, they went down after they went up." So we're still in the same place as we were a month ago. A month ago we were here, then we went up here, now we're back down here. And that's really kind of how it's been. It's been up, down, up, down, up, down, up, down, still with a 6 handle in front of everything, but it's a matter of whether it's a low 6 or a high 6 and what's going on in the world. But God forbid, we've said this before, don't say 7, because then don't say 7, because everybody freaks out. Like I could say 6.99, I'll say 7. Oh, that sounds crazy high. So it's
All right. I figured we'd kind of do a mock activity. I was talking to a buyer the other day, first time home buyer, and they so I recommended, speaking to a lender. I said, I have a lender of choice that you could speak to. So they asked me and said, well, what can I expect in this phone call or this meeting? So I think it'll be valuable for the people who are watching and who are going to watch this later that have never been through a consultation with the loan officer to maybe kind of just do a mock trial. Are you okay with that?
Yeah, we can do that. Absolutely.
So we're gonna do a little bit of scripting and role play here. So I'm gonna pretend to be the buyer, and you are who you are.
All right, we do that.
So just to set up the scenario, I'm a first-time home buyer. This is the information that you have. I'm a first-time home buyer. I was referred to you by a realtor contact that you've worked with in the past. And this is our first phone call.
Okay, very good.
Okay. So Christian, I'd like to buy a house.
That's nice. That's nice. Where do you want to buy one?
So I'm thinking that I like Westchester County. I am open to Rockland County as well, but I definitely want to stay out of the 5 boroughs.
Okay. So have you looked at anything, when you spoke with the realtor? I mean, did you call them on a listing, on a specific price point, a certain area? Like, have you seen anything that's caught your eye, like a particular price point that's caught your eye in those areas?
So I was looking online and I saw a nice house that was located in Yonkers. I clicked on the ad and then he called me, about a day later, and he kind of just was telling me that property wasn't available anymore. And he was asking me if I was pre-approved, and I didn't even really know what he meant by that. So that's kind of how we ended up here.
Okay. So Yonkers, how much was that house?
The house, I believe, was $675.
Okay.
But it's funny, like maybe you could tell me, like it looked like it said it was just listed like a week ago, and now he said it was unavailable. I didn't really understand how somebody already paid $675,000 for that house already.
Well, they didn't necessarily pay for it yet, but they may have an offer that's accepted and they might be going through the process. But yeah, the market is moving that quickly, which is why you want to be armed with a pre-approval. So when you're looking at the next house, you're ready. If you like it, you're ready to make an offer right there because things are moving very fast and you need to be ready for sure.
Gotcha. Yeah. I mean, I'm currently renting right now. I've been a renter my entire life, but my landlord, what really prompted this was my landlord raised my rent like $300. Which is basically like a little over 10% of what my rent was. And I said to him, I said, well, how come you're raising the rent so high? And he told me that it's because interest rates are going up and his payments were going up. So I was like, you know what? I might as well try to, buy a house so that way I don't have to deal with these increases all the time.
Yeah. I mean, there's no doubt that buying is better than renting for that exact reason. I have a lot of clients right now that their landlords are selling the house that they live in and they're being forced to move out because the new buyer doesn't want to bring them in as tenants. They want to live in the house themselves. So you'll never have better security.
This guy's mom owns the property. He's a nice guy, so I don't think he'll throw me out, but I definitely want to, start getting some sort of real estate in my arsenal.
Okay. Well, I mean, the one thing I'll start out with is, I mean, you're applying for a mortgage is definitely not like anything you've ever applied for before. If you bought a car before, if you've leased a car, there's usually a one-page application. It's all basically stated. They ask you your job history, they ask you your income, but they don't verify any of it. It's really mostly credit-based when you buy a car or you're getting a credit card or any type of kind of credit application. With mortgage, we have to verify everything with paperwork. So it's not as simple as really just me running your credit and asking you what you do and how much you make. We need to have all the documentation behind that when we do the mortgage application. There's, the applications are also multifaceted. Credit really just opens the door. Your credit score will tell me what better product might be better for you, whether it's a conventional loan, an FHA loan, or something outside even that box. Your credit score will help determine the product that's better, but your income is going to determine how much we can lend you. Your income and your expenses that come off that credit report. So the main reason we're pulling the credit report is not at this stage, not so much about the score. It's more important to see what your other expenses are, car payments, student loans, credit cards, because I have to make sure that your mortgage payment fits within a certain percentage of your monthly income. So, so we're going to calculate a monthly payment on a particular house. And then when I look at your car payments, everything else, we have to make sure that the total payments there fit within a certain percentage of your income.
Okay.
And we verify.
Great credit. I got great credit, so I'm not worried about that.
All right. Good. So, just to expedite what we're doing here, we'll assume, all right, we pulled your credit. Your credit's a 740. You have a car payment, $600 a month. Okay. What's your occupation, Steve?
I work as I'm a salesperson for a printing company.
Okay. So, and how are you paid? Are you paid a salary or hourly?
Yeah. So it's just straight salary.
Okay. So salaries are actually easy. How much is your annual salary?
So when they gave me my job offer, they said it was probably going to be around $75,000 per year.
Okay. So is it exactly 75,000? Is it plus or 75 and change? Is it 74 and change?
They said I could qualify for a bonus if I hit certain numbers, but my salary is $75,000 per year. Okay.
All right. Very good. So one of the things that we will verify are your pay stubs and W-2s. So if you don't have those ready, if you can go on your ADP website, or if you or if you have to go to your employer, before I would actually give you the full pre-approval letter, we would just need your most recent 1 month of pay stubs and your last year's W-2.
So my W-2 from last year is going to be a bit lower because I just got this job. I'd say probably maybe, I don't know, 4 or 5 months ago. And and before that, I was out of work for a little while, but I've been at this job for about 4 or 5 months. So my W-2 won't show a full year, but I definitely did make some money, but it wasn't the $75,000 that I'm able to make now.
That's fine. We do need to document a 2-year work history for your application. So and gaps are allowed also within a certain, depending on the type of loan, gaps are, as long as they're explainable, you're allowed to have a gap of employment. But the income you're making now on the salary is what we're going to use to qualify you. So if you have the current pay stubs, we'll do that. We'll get those, and that's what I would use. But I would need to document a 2-year work history to get you an official pre-approval and also get you through underwriting later. So skipping forward a little bit, I'll say we got the 2-year history.
Yeah.
Right. All right. So now, what about now? Another portion of the application is obviously your assets. Your assets are going to determine what loans are better for you, whether, again, we're talking FHA, Sony May, conventional loans, Sony May loans on single family homes allow for just a 3% down payment. FHA is 3.5%. But obviously the more you put down, the less your payment is going to be. So, I may have one person that can qualify for a $600,000 house because they have 20% to put down and that monthly payment is lower, versus the other person is only 3% down because that payment is higher. Even with a similar income, borrower B might not qualify. Borrower A will qualify because of the bigger down payment.
Gotcha. So I have I have $100,000 to put down on a house.
Okay. So,
and then Christian, you have some sort of I heard that first time home buyers, you have some sort of grant or something that could help me with either down payment or maybe there's closing costs, I think, right? Like I have to pay a lawyer and stuff like that.
Right. So, closing costs are typically 3 to maybe 4% of the price, depending on where you're looking. There's a difference between Westchester and Rockland in closing costs, because in Rockland, we have to account for more property taxes being collected at the closing. So you mentioned Rockland. If you're buying in the Bronx, the actual closing cost could be a little higher because there's a higher tax on the mortgage there versus the property taxes. So 3 to 4%. 4% is definitely a high number. You'll definitely, when you're putting a larger down payment down, you're going to be closer to 3. But really, once we kind of dig into what you're looking for and what you're actually buying, we would give more of an itemized estimate so you know exactly what's in there. But I always tell people, if you're ballparking it, if you're just looking around with your agent and you're driving around, you see a house listed, account for your down payment and 3 to 4% for closing, and there won't be any surprises for you later.
Yeah. Okay. Yeah, I got that. I got the $100,000, and then I have my grandmother gifted me some stocks when I was very young. So I've probably got like another maybe 20-30 grand in stocks that I can cash out.
Okay. Yeah, all that stuff will be verified also with the application. We have a system actually that connects directly to your bank when we do the online application. All the larger banks are using it. It's basically a pass-through from our loan application into those banks, and then we'll validate a 60-day transaction history for any accounts that you put in there.
Wow.
Yeah, it's pretty cool. So but we do have to be able to document the money for the down payment and closing costs. And if we're doing a conventional or FHA type loan, we only have to document the down payment and closing costs. You don't need reserves, even though I would recommend having some reserves when you're buying a house. You don't have to show extra money on top of that, aside from what we're using for the transaction. So
should I add? So should my wife be on the mortgage as well?
If we need her income, absolutely. I have people that, going back to what I was originally saying, that the basis of the amount that we can lend you is based on your income and expenses. So if I have one person on with one salary, you're going to be limited up to a certain number, versus if I have 2 salaries on there, you're going to be going up to a higher number, because now I show that I have more monthly income to support a monthly payment. So her
credit is not as good as mine, though.
Well, it doesn't have to be perfect. We have loans that'll go down even to a 520 credit score, through FHA. So it doesn't have to be perfect. But when I'm doing once we kind of factor a price point, I'd be able to help you determine, if we can get you a slightly better rate with her not being on the loan, because the rate is going to be based on the person with the lower score. Okay. So if I have 2 incomes and I need both incomes to get you to the loan you want, then we're going to have to deal with that lower credit score when it comes to rate and product. But if I can qualify the person with maybe the higher income, and there's enough there to support what you're trying to do, I could take off the spouse and we can get you, usually a better interest rate that way.
Okay. All right. I guess you'll run the numbers and let me know. In the meantime, I'll have her fill out the application as well.
Right. Okay. So yeah. So again, as far as paperwork, what we would want to validate, usually at this point, I would either take, I would obviously be inputting everything over the phone, or in some cases, I would direct them straight to my website so they can input their stuff securely there.
Yeah.
Our system also a lot of times can tap directly into their employers. So I have some applications where I have income validation, I have asset validation all digitally on my application without having to get any paperwork from the borrower. But if their employer does not use Experian or ADP or one of the systems that we can tap into through their employer, I would need the pay stubs, the W-2s, or things like that. So and that all basically blends along with how the phone call is going and what I can digitally validate versus what I can't digitally validate.
Gotcha.
So, and then at that stage, once I have all the information there, we would put it through underwriting. So, we once the application is in there, we'll run it through Fannie Mae or Freddie Mac's underwriting system. They'll run all the algorithms. We'll get an approval there, and then we can put out a pre-approval letter after we have the approval through the agencies.
Okay.
So and then again, once we have that there, once we establish the budget, now deviating from our mock phone call, the way that I usually do my pre-approvals is, and sometimes it can be frustrating for the buyers, but I always will ask what they want to spend versus the absolute maximum I can get. And I can tell you 9 out of 10, I hit the nail on the mark as far as where I think they should be versus where the guidelines say they can be.
Yeah.
And I always say, I use the analogy all the time. If you told me you wanted to buy a car and you wanted to spend $500 a month, I'm not going to send you to go get a Ferrari. I'm not, that's not where you're going to go to get that car. So if you want to spend $2,000, $3,000, $4,000 a month, and you're really, even though you can qualify for an $8,000 mortgage payment, you might not want that $8,000 mortgage payment. So I'll drill it down to what you want to spend, and then send them back to Steve to say, like, okay, this is what they want to spend, so this is what you have to find. Now, in this market, some people's budgets are just lower because they don't really know, especially if they haven't bought before, they don't know what things will cost. So I'll start the conversation there, and then I'll tell them, okay, this is where you would be with that budget. And based on where you are buying, you might not find something in that, in that price point. So then I'll look at the town, the village, the county where they're looking to buy, and I'll know the average, price range based on what they want to buy. And I'll say, well, in that area, you're going to find probably $450 minimum to $650 based on what you want. So this is where that payment would be, also based on how much money you have to put down, what your credit looks like, including taxes, including PMI if there is any, regular insurance. Insurance costs are going up now too. So even we used to use where I used to only use maybe 100 to 150 as a monthly expense for homeowners insurance. Now I'm using 200, 250. Because you don't want to get bit later when we're qualifying them with insurance of 100 and 150, and then when they actually get us the insurance, usually towards the end of the transaction, and it's 300 a month, that could be enough to blow a deal up. See, I like to be as conservative as possible when I'm calculating an average monthly payment for somebody at this stage, so there's no surprises later. Usually they come out happier because I'm being extra conservative from the beginning, explaining to them that if you move from one town to the next, your property taxes could be $10,000 in Yonkers. They could be, $15,000 in White Plains. They could be, $20,000 here, $6,000 in the Bronx. So knowing, those differences and working with people that are local and knowing those differences is going to get you a more accurate pre-approval. So you're going to get the loan later.
Of course. Yeah, I'm the same way with the conservative stuff. Like I tell buyers all the time. Same thing with sellers. I'm like, look, I'm going to give you my best professional opinion, but just know it's always going to be either I'm going to go a little bit higher or a little bit lower, so that way you feel more satisfied when the transaction happens. Because the last thing I want to do is tell you your payments are going to be $2,000 a month, and then all of a sudden $2,400, and now you're just like, Steve, what did you tell me this for?
Right. But I usually, when I ask the question, how much do you want to spend in our area, most people are looking to spend about 25% of their gross income. That's what I'm finding, what they tell me.
Mm-hmm.
The guidelines will allow them to go. The guidelines say you can be comfortable with 33% of your income. And in some cases, they'll allow you to go up as high as 50% of your income. Now, I always preface that with telling people that's not recommended. But the reason for that is sometimes we do have a spouse that can't be on the application for one reason or another. So, and there might be extra income that we're just not putting on the application, but the buyer knows they can make the payment because there is that extra income. So that's really why the guidelines allow you to go as far as they allow you to go, because not every borrower is cookie cutter that's going to fit this perfect debt ratio credit calculation. Everybody's paid differently. Their lives are different. Some people have, 3 side hustles going on and they're 1099 and they're, so that's why I always like to lead with the payment, where you want to be, and based on that, where you're going to get to, and then, work through the conversation from there.
And how long does that underwriting process take for you to turn around and get them a pre-approval once you have all the information?
Once it goes through underwriting, I mean, it's really, we're clicking a couple buttons and we get an approval right then and there. It's within
it's an algorithm.
Right. The algorithms will run it there. So, the next stage on that is to actually put it in front of a human underwriter. So if we're doing a full loan commitment without an address attached to it, that can take 24 hours because it has to get in the queue and actually be looked at by an underwriter to get that commitment. And that's really when we start getting into the differences of pre-qualification, pre-approval, commitment. All those they are different.
Yep. All right, man. So I'm gonna go house hunting.
All right. I didn't really give you a price point, but we got halfway there. We might need another half hour, but I think we got the gist.
Well, no, listen, I think that was super helpful. Just people, if you don't know what you don't know, right? So for us, we're dealing with this every single day, and we're throwing numbers out there. You're approved 800,000. Oh, you want to buy this house? This house is selling for $1 million. But those numbers are scary for people, and they're just like, they just don't know what to do. So
this is what I recommend before you speak to a lender, like as far as a checklist of things that you should be prepared for. Be prepared to think about what your monthly budget is on a house, and knowing that it's going to include taxes and insurance and everything. And I always say to people, because people say, well, I don't know what it's going to cost. I don't know. I was like, all right, let's put it this way. If you were going to go rent a house, how much would you want to pay? And I'll start there, because they really don't know what goes into the payment. So I would recommend. If you're self-employed, be ready with 2 years of tax returns. Have them at the ready. Have them as a PDF, ready to be forwarded. Because a lot of times when we get into that conversation, I tell people what they need. I don't hear back from them for 2-3 days, and then I have to chase them to get the documents. And then my realtor is saying, "Where's my pre-approval?" And all that stuff. So be prepared for that. If you're not self-employed, be prepared for 1 month of pay stubs and last year's W-2. If you're a W-2 borrower, look at your 401k, know what you can pull out, what you can't pull out, how much money you have access to, and where it's going to come from. Whether it's gifting or anything like that, just be prepared to have that information. And most importantly, if you're buying with a spouse or a partner, have their social security number. Or have that, even better, have that person with you so I can take their own social security number over the phone. But if you're married, know your spouse's social security number, because I can tell you how many times that happens where I'm halfway in the conversation. I'm like, okay, what's your spouse's? So right after I took their social, so it's coming. Like, what's your spouse's social? Oh, I don't know. I got to go get it. And again, I might not hear back from that person right away, and it just breaks it up. So definitely have the co-borrower's, your spouse's social security number, date of birth, and then the rest can flow from there.
Very, very helpful. Christian, thank you so much, man. So maybe next week we'll experiment a little bit, because that was kind of like a first-time home buyer, W-2 employee. Maybe next week we'll get back and we'll do something like you said, like a self-employed or a 1099 sort of employee, and we can kind of start really diving into
it. No, exactly. Because that'll dig into a lot of the newer non-QM products for self-employed borrower that have come up in the last few years that are no longer just held within the box. So yeah, that's going to be a good conversation.
Good. Well, listen, man, you have a wonderful week, and thank you very much.
You too, bro. Thank you.
Later.